Assalamualaikum and hi to everyone. We are Group 3 from JBA 2791A and 1B. Our group will be presenting an analysis of corporate financial performance for two public listed companies, which are Sandabi Berhad and Sarawak Oil Palm Berhad. Let me introduce my group members. Nur Alia Batrisha binti Iskandar, Syafiqah Atrisha binti Suhaimi, Rabiatul Adawiyah binti Ahmad, Nik Nur Akila binti Nikmut, and Nur Faiza binti Abu Samad. Samdarbi Berhad was founded in 1910 by William Syme and Henry Darby, originally operating in the rubber industry. Over the years, the company expanded into palm oil and other sectors and grew into one of Malaysia's largest multinational corporations listed on Bursa Malaysia with operations across the Asia-Pacific region. Today, Samdarbi focuses on sustainable growth, strong corporate governance, and delivering consistent financial returns. Next, Sarawak Oil Palm Berhad was established in 1968 as a joint venture between the Commonwealth Development Corporation and the Sarawak government. The company was listed in Bursa Malaysia in 1991 and is mainly involved in oil palm cultivation and palm oil milling, with additional activities such as property development and downstream products. For our financial analysis, we follow a systematic research process to ensure the reliability of our data. First, we obtain all financial information directly from Bursa Malaysia, focusing on the company's latest audited annual report. These include the statement of financial position, statement of profit or loss, and cash flow statement. Next, we cross-check the figures with the company official corporate website to ensure consistency and accuracy. There are several key reasons why we selected Samdarbi Berhad and Sarawak Oil Palm Berhad for this study. Firstly, both companies operate within related industry, particularly plantation and agribusiness, which allows for a more meaningful comparison of financial performance. Then, the companies differ significantly in scale and business structure. Samdarbi is a large, diversified multinational company, while Sarawak Oil Palm is more focused on plantation-based operations. This contrast helps us evaluate how company size and diversification affect profitability, efficiency, and financial risk. Now, we are looking at the profitability ratios over the 5-year period. Starting with profit margin, the margin was 2.36% in 2020, increased to 3.44% in 2021, dropped slightly to 2.79% in 2022, then improved to 3.13% in 2023, and reached the highest at 4.51% in 2024. The increase in 2021 indicates better cost control, while the strong improvement in 2024 suggests improved operational efficiency and stronger profitability. For return on asset, it's recorded 3.20% in 2020, 5.37% in 2021, 3.93% in 2022, 4.08% in 2023, and increased to 5.8% in 2024. The higher return on asset in 2021 and 2024 show the company became more efficient in using its asset to generate profit. However, for return on equity, Samdarbi recorded a higher ROE of 40.15% compared to Sarawak Oil Palm Berhad 11.59%. This shows that Samdarbi is generating higher returns for its shareholders, possibly due to better capital structure management or higher leverage. Profitability margins are important because they show a company's ability to generate profit from its operation. Higher profitability indicates better cost control and operational efficiency, which help the company remain competitive. From an investor point of view, strong profitability increase confidence in the company's financial performance. Therefore, profitability ratio provide a quick and clear indicator of company's overall financial health.
For the next ratio, I will explain about asset utilization ratio. Asset utilization ratio show how efficiency Standard Berhad use its asset to generate sales and manage operation. The receivable turnover increased from 9.14 times in 2020 to 10.29 times in 2021, indicating faster collection from customers. However, it declined to 9.24 times in 2020, 8.22 times in 2023, and 8.18 times in 2024, showing slower receivables collection in recent years. This is supported by the average collection period, which improved from 40 days in 2020 to 35 days in 2021, but then increased to 40 days in 2022, 44 days in 2023, and 45 days in 2024, indicating longer time taken to collect payment. The inventory turnover rose from 4.40 times in 2020 to 5.32 times in 2021, reflecting efficiency inventory management. However, it declined to 4.64 times in 2022 and 4.22 times in 2023, before slightly improving to 4.55 times in 2024. The fixed asset turnover increased from 6.11 times in 2020 to 7.12 times in 2021, peaking at 7.40 times in 2022. After that, it fell to 6.04 times in 2023 and 5.36 times in 2024, showing reduced efficiency in using fixed asset. Lastly, the total asset turnover increased from 1.35 times in 2020 to 1.56 times in 2021, but declined to 1.41 times in 2022 and remained at 1.30 times in both 2023 and 2024, indicating weaker overall utilization. Asset utilization ratio show how efficiently the company uses its asset to generate revenue. Receivable turnover and average collection period measure how quickly credit sales are converted into cash. Inventory turnover shows how efficiently inventory is managed. Fixed asset turnover indicates how effectively fixed asset generate sales, while total asset turnover reflects overall asset efficiency. This ratio helps management improve operation and help shareholders, suppliers, and banks assess performance and cash flow.
Hi, my name is Nur Aga Batisha binti Iskandar. So now we will continue with 03 liquidity ratio. So first is current ratio. Standard Berhad had a stable liquidity position in 2020 with ratio 1.52. In 2021, the ratio increased to 1.64, showing an improvement in the company's ability to meet short-term obligations. However, from 2022 onward, the current ratio declined from 1.52 to 1.36 in 2024, indicating increasing pressure on short-term liquidity. Overall, this showed that Standard Berhad liquidity position weakened after 2021. Moving on to the quick ratio, the company required a ratio of 0.64 in 2020, which indicate limited immediate liquidity. The ratio improved to 0.78 in 2021, but declined again from 2022 to 2024, reaching 0.61 in 2024. Similar to the current ratio, the quick ratio trend show that surrender by Berhad short-term liquidity weakened after 2021.
My name is Nur Faiza. I will be presenting on the utilization ratio Sunday Berhad from 2020 to 2024. This ratio shows how much a company relies on debt to finance its operation or assets. So firstly, debt to total assets. In 2020 to 2021, the ratio decreased from 14.83% to 13.11%, meaning Sundarbi relied less on debt during this period. This shows a more conservative approach, lower financial risk, and stronger solvency. However, in 2022 to 2024, the ratio increased sharply from 16.64% to 25.49%, indicating growing reliance on debt to finance assets. Next, time interest earned. In 2020 to 2021, the times interest earned increased sharply from 10.91 times to 25.93 times, indicating that Sundarbi ability to cover interest expenses improved significantly. This could be due to higher operating profits or lower interest costs, giving the company a strong buffer to meet debt obligation. However, in 2022 to 2024, the times interest earned declined continuously to 4.78 times by 2024, showing a weakening ability to pay interest. The decline might result from higher interest expenses, lower operating profits, or fluctuation in EBIT. For fixed charge coverage in 2020 to 2021, the fixed charge coverage increased significantly from 10.91 times to 25.93 times, showing that Sundarbi Berhad had a very strong ability to meet fixed financial obligations such as interest and lease payments. This indicates low financial risk and a healthy buffer between earnings and fixed costs. But in 2020 to 2024, the fixed charge coverage declined sharply to 4.78 times by 2024. A decreasing fixed charge coverage suggests that the company's ability to cover fixed charge is weakening, possibly due to rising debt levels or high fixed costs. Significant and important of debt utilization ratio is to help investors to assess financial risk before investing in a company. Plus, it helps creditors to evaluate the company's ability to repay loans and interest, and help analysts to assess financial health and solvency of a company.
Now I will compare the profitability performance between Sundarbi Berhad and Sarawak Oil Palm Berhad based on the latest year. Sarawak Oil Palm recorded a higher profit margin of 8.22% compared to Sundarbi 4.51%. This indicates that Sarawak Oil Palm Berhad is more efficient in controlling costs and converting revenue into profit, likely due to its more focused plantation operation. In terms of return on asset, Sarawak Oil Palm Berhad also outperformed Sundarbi with 8.48% compared to 5.84%. This suggests that Sarawak Oil Palm Berhad is more effective in utilizing its asset to generate profit, where Sundarbi's larger and more diversified asset base may dilute asset efficiency. However, for return on equity, Sam Darby recorded a higher ROE of 40.15% compared to Sarawak Oil Palm Berhad 11.59%. This shows that Sam Darby is generating higher returns for its shareholders, possibly due to better capital structure management or higher leverage.
For the next comparative asset utilization ratio, which is receivable turnover, in 2024, Sarawak Oil Palm Berhad recorded a higher receivable turnover of 50.34 times compared to 8.18 times for Sandarbi Berhad, indicating faster and more efficient collection of credit sales. For the next one, average collection period, Sandarbi Berhad had a longer average collection period of 45 days compared to Sarawak Oil Palm Berhad 24 days, showing slower receivable collection. For inventory turnover, Sarawak Oil Palm Berhad recorded a slightly higher inventory turnover of 4.64 times than Sandabi Berhad 4.55 times, indicating marginally better inventory management. For the fixed asset turnover, Sarawak Oil Palm Berhad show a significantly higher fixed asset turnover of 78.20 times compared to 5.36 times for Sandabi Berhad, indicating more efficient use to fixed asset. Lastly, total asset turnover. Sandarbi Berhad achieved a higher total asset turnover of 1.30 times compared to Sarawak Oil Palm Berhad 1.02 times, showing stronger overall asset utilization.
So now let's analyze the liquidity position of Samdar Berhad and Sarawak Oil Palm Berhad in 2034 using the current ratio and quick ratio. Starting with current ratio, we see that Sarawak Oil Palm Berhad has a value of 4.06, which is significantly higher than Samdar Berhad's 1.36. This indicates that Sarawak Oil Palm Berhad hold a higher level of current asset compared to Samdar Berhad. On the graph, you can clearly see Sarawak Oil Palm Berhad's bar is much more taller than Samdar Berhad's, showing a stronger liquidity position. Overall, Samdar Berhad ratio clearly lower than Sarawak Oil Palm Berhad. Looking at the quick ratio, which focus on the company's most liquid asset, Sarawak Oil Palm Berhad again shows a much higher figure of 3.16, while Samdar Berhad is only 0.61. This shows that Sarawak Oil Palm Berhad is in a much stronger position to cover immediate needs compared to Samdar Berhad. On the graph, the difference is very noticeable, with Sarawak Oil Palm Berhad's bar being over 5 times taller than Samdar Berhad's.
I will explain comparative analysis between Samdar Berhad and Sarawak Oil Palm Berhad for debt utilization ratios. Samdar has slightly higher debt proportion, 25.49% of its total assets are financed through debt compared to 23.51% for Sarawak Oil Palms. This means Samdar Berhad relies more on borrowed funds to finance its assets than Sarawak Oil Palms. Next, Samdar Berhad has lower times interest earn ratio 4.78 times, then Sarawak Oil Palms Berhad 8.08 times. This is because Sime Darby has a slightly higher debt level, resulting in greater interest obligation and may also have lower operating profits relative to its debt. Lastly, Sime Darby Berhad has lower fixed charge coverage 4.78 times than Sarawak Oil Palms Berhad 7.92 times. This is due to Sime Darby Berhad having slightly higher fixed obligations. As a result, Sime Darby Berhad has a weaker ability to indicate higher financial risk, while Sarawak Oil Palms' stronger coverage reflect greater stability and a more comfortable capacity to pay its fixed charge.
First recommendation is for liquidity ratio. Sime Darby needs to reduce its short-term debt to ensure it has enough ready cash to pay bills without depending too much on selling its stock. This move will protect the company from rising interest rates and keep it financially stable following its recent big executions. Sarawak Oil Palms Berhad should use its extra cash to upgrade its machinery, to replant older trees to increase future profits. Since the company has a lot of money sitting in the bank, using it for this improvement is better than letting it stay idle, as it helps the business grow without needing to borrow more from banks. Debt ratio. Sime Darby should focus on reducing its debt levels now that it has finished its major business purchases to keep interest costs low. By paying off these loans, the company can protect its profit and remain financially strong even if market conditions become difficult. Sarawak Oil Palms Berhad should maintain its current low debt level as it provides a strong safety net against changes in palm oil prices. This safe position allows the company to fund its own future growth and pay steady dividends without needing to borrow expensive money from banks. Activity ratio. Sarawak Oil Palms Berhad should focus on selling its palm oil stocks faster to ensure cash doesn't get tied up in the warehouse for too long. This faster movement of goods ensures that the company is using its assets efficiently to bring in steady income throughout the year. Sime Darby should focus on selling its inventory of vehicles and machinery more quickly to avoid keeping too much money locked up in unsold stock. By speeding up how fast they move these high-value items, the company can generate cash faster to pay off its debts and reduce the cost of storing and maintaining unsold goods. This efficiency is especially important now to help the company stay stable after its recent large business purchases. Profitability ratio. Sime Darby should focus on lowering its daily expenses and selling products that offer better profit margins. By making their operations more efficient, the company can ensure they keep more money as actual profit after all costs are paid. Sarawak Oil Palms should invest in ways to produce more oil from the existing land and reduce their overall production costs. This will help the company stay profitable and maintain steady earnings even when market prices for palm oil change. In conclusion, this report shows that while both companies are stable, they require different financial strategies to grow. Sime Darby needs to focus on reducing its short-term debt and selling its inventory faster to protect its cash flow after making large executions. Meanwhile, Sarawak Oil Palms in a very safe position with a lot of extra cash. So, it should focus on using that money to improve efficiency and lower production costs. Overall, managing debt wisely and keeping operation efficient will ensure both companies remain profitable in a changing market. That's all from our group. Thank you for listening and hearing our presentation. Bye.